After you've made your adjusting entries, the next step is to actually now prepare your financial statements, but we're going to do something different and include what's called a classified balance sheet. So you're still going to make your 3 financial statements, so you will prepare your income statement, revenues minus your expenses. The net income or the net loss will flow into your statement of changes in owner's equity. From then, the ending capital will go onto your balance sheet. So I'm taking you right back to chapter 1. But the balance sheet, you need to actually separate out your assets and liabilities. So let me show you how that's done. First, we've got your adjusted trial balance. So once you've made your adjustments, then you prepare what's called an adjusted trial balance to make sure that you actually balance, that your debits do equal your credits, and you've got your supplies, you've updated your prepaid rent, your office supplies, all that good stuff. After you've prepared an adjusted trial balance, then we're going to prepare your financial statements. Okay, and we already know that you prepare your income statement first. Net income or net loss will then flow into your statement of changes in owner's equity. From there, the ending capital from your statement of changes in owner's equity will flow into the balance sheet. So nothing changes there. So here's what your income statement, same thing, revenue minus your expenses, but now we've got supplies expense, your depreciation expense, your salaries expense has probably been updated, rent expense, as well as your interest expense. So now we're using what's called the accrual method of accounting. Once you've prepared your income statement, your net income or net loss flows into your statement of changes in owner's equity. From there, you're going to get your ending capital, and that's going to flow into the balance sheet. But your balance sheet, okay, this is what you're used to it looking like. All of your assets equals your liabilities plus your owner's equity. And you might want to jot down that this is in what's called account form, okay? Going to show you the report form in just a little bit, but this is the way that this is set up side by side. This is the account form. So if we take a look, we're going to actually, oops, wrong way. We're going to actually kind of separate this out so that we can look at our current assets, our property, plant, and equipment, our intangible assets, and then we'll also look at what part of the liabilities is current, what part is long-term. So to do that, we're going to actually prepare a classified balance sheet, not just a balance sheet, but a classified balance sheet. Okay, just a reminder, you might want to write this down. Assets are shown in order of liquidity, which means you want to liquidate. How easy is it to convert those assets into cash? And so our most liquid asset would be cash. Liabilities, like I said, you'll classify them current versus long-term. So any payables that are due within the year need to be listed as current, and the ones that are due after 1 year would be classified as long-term. So you may have a note that's due in 10 years, but you're paying on it every year. Part of that would actually be current, and part of that payable would be long-term. So you'd have to separate the two out. Current assets will be converted to cash, sold, or used up within the next 12 months. Okay, so obviously that's going to include your cash, accounts receivable, okay, supplies, prepaid, for the most part, your prepaid expenses. So let's take a look. Long-term assets you might want to write down. we've got long-term investments. So sometimes companies do actually invest. So not only can people make investments, but companies may also make investments. So a long-term investment would be if the company had invested in stocks or bonds. Then we have what's called property, plant, and equipment, PPE, property, plant, equipment. Property is land, plant would be buildings, and equipment is equipment, furniture, stuff like that. And we have our intangible assets, and these really have no physical form. They just carry some special rights, like a patent or copyright or a trademark. Current liabilities would basically be your accounts payable, your salaries payable, your unearned revenue. Those are all current liabilities. For the most part, your notes payable are usually long-term, but part of that notes payable may actually be a current liability. All right, and then we've got our owner's equity. Remember, that represents your owner's claim to the assets of the business. We need to take a look at what happens to it based on the investments the owner made, what net income or net loss does to your equity, and what the owner has taken out. So this is what your balance sheet is going to actually look like. And this is actually in report form. It's not account form side by side. But now we don't just have assets, we've got current assets. We've got property, plant, equipment, and then eventually we'll get into our intangible assets. For our liabilities, we want to divide it out into current liabilities as well as our long-term liabilities. Okay, and your assets then, your total assets will equal your liabilities plus your owner's equity.